It didn't make headlines. There were no crowds, no speeches, no breaking news alerts. And yet, that single decision quietly made millions. Not overnight, not loudly, but steadily, like a river changing direction beneath the surface of the earth. At the time, almost nobody noticed. The year was tense, markets were unstable, governments were juggling debt, investors were divided between fear and blind optimism. Newspapers were filled with stories of crisis, speculation, and political drama. But buried beneath all of that noise was one quiet room where a decision was being debated. The room wasn't grand, no golden chandeliers, no television cameras outside the doors, just a long wooden table, stacks of data reports, and a handful of individuals who understood that timing is more powerful than attention. The proposal looked small, almost boring. Shift reserve allocations from short-term speculation into long-term infrastructure bonds. That was it. No flashy expansion, no dramatic acquisition, no risky innovation, just a reallocation. At first glance, it looked conservative, even timid. Some inside the room argued it would reduce short-term gains. Others worried about appearing inactive while competitors chased aggressive returns. But one person in that room saw something different. He wasn't the loudest voice. He wasn't the most decorated economist. He didn't dominate the table with charisma. He simply understood cycles. He had spent decades observing markets breathe, expand, contract, overheat, cool down. He had learned that the most profitable moments are rarely when everyone is excited. They are when everyone is distracted. And right now, everyone was distracted. Technology stocks were soaring, commodities were fluctuating wildly, venture capital was pouring into untested startups, the media was obsessed with disruption. But infrastructure? Infrastructure was quiet, predictable, ignored. He leaned forward and said calmly, "When attention is elsewhere, value hides." Some nodded politely, others remained skeptical. Because the truth is simple. Patience rarely wins arguments against excitement, but patience often wins history. After hours of debate, the vote passed, narrowly. Funds were shifted, capital was repositioned into long-term assets tied to transportation networks, energy grids, water systems, and municipal development projects. The headlines didn't change. The public didn't react. The market barely blinked, and that's exactly why it worked. Over the next few years, something subtle began happening. The speculative sectors that once looked unstoppable began showing cracks. Overvaluation met reality. Cash flow mismatches emerged. Debt levels tightened. Some high-profile companies collapsed. Investors who chased speed felt the shock first. Meanwhile, the quiet assets, the roads, the ports, the power stations continued operating. People still needed electricity, still needed transportation, still needed water. Revenue didn't spike dramatically. It simply continued, steady, reliable, compounding. Then came the downturn, a global slowdown triggered by tightening credit and cascading defaults. Markets dipped sharply. Panic spread through trading floors and digital dashboards alike. Speculative positions evaporated, liquidity dried up, and suddenly the assets that once looked boring became anchors. Governments couldn't let infrastructure fail. Revenue streams tied to essential services held stronger than most corporate earnings. Investors searching for safety began rotating capital into exactly the sector that had been quietly accumulated years earlier. Demand rose, valuations climbed, and without announcing anything, without ringing a bell, without declaring victory, the institution behind that quiet decision began generating extraordinary returns. Not explosive returns, sustainable ones.
compounded over time. Millions flowed in, not from hype, from positioning. The beauty of the decision was not that it predicted the crisis, it was that it prepared for uncertainty, and preparation is invisible until tested. The man who had advocated for the shift didn't celebrate publicly. He simply monitored the data, adjusted risk exposure, and reinvested profits back into similarly stable long-term assets. He understood something deeper than profit. He understood leverage through patience. While others relied on volatility for gains, he relied on inevitability. Cities grow, energy demand rises, transport expands, population increases, essential systems endure. He wasn't betting on trends, he was aligning with reality. Years later, analysts would try to pinpoint the moment the institution separated itself from competitors. They would look at earnings reports, they would analyze quarterly growth, they would credit strategic diversification, but very few traced it back to that quiet meeting, because history often hides in small rooms. As returns accumulated, something interesting happened. Confidence shifted internally. The leadership began trusting long-horizon thinking more than short-term applause. Risk models were adjusted to prioritize resilience over excitement. Reserve ratios were strengthened, debt exposure reduced, the culture transformed. And culture is the most underestimated compounding asset in finance. Competitors who once mocked the conservative approach began replicating similar strategies, but later at higher prices. Because timing doesn't just influence profit, it determines entry cost. By the time others recognized the value of infrastructure-backed assets, valuations had already adjusted upward. The early move captured the margin, quietly. Meanwhile, the man behind the proposal continued observing broader patterns. He noticed demographic shifts, urban migration accelerating, energy transitions beginning, digital infrastructure blending with physical networks. He proposed incremental expansions, not radical leaps, into adjacent sectors that reinforced the core stability. Fiber optic networks laid alongside transportation corridors, renewable energy integrated into existing grids, smart logistics layered over traditional ports. Each addition strengthened the ecosystem. It wasn't growth for attention, it was reinforcement for endurance. Over the next 10 years, the returns compounded beyond initial projections, not because markets were always favorable, but because volatility became opportunity instead of threat. When asset prices dipped, reserves allowed additional acquisitions. When credit tightened, strong balance sheets attracted favorable financing terms. The institution became known, not publicly flashy, but internally respected among serious investors. It became the place capital moved to when uncertainty rose, and that reputation itself generated value. Trust reduces transaction friction. Reduced friction increases velocity. Velocity increases return. All from a decision that barely made a headline. But part one of the story isn't about profit. It's about perspective. Because what truly made millions wasn't infrastructure alone. It was the willingness to look boring in a world addicted to noise. And the next chapter would prove that the original decision was only the foundation for something even bigger.
The real power of that historical decision didn't reveal itself in the first downturn. It revealed itself in the second. Because surviving one crisis can be luck. Surviving multiple cycles is structure. Years after the initial shift into infrastructure, the global economy entered a new phase. Rapid technological acceleration mixed with rising geopolitical tension. Digital markets were expanding faster than regulatory systems could adapt. Capital flowed aggressively into innovation once again. And once again, the noise grew loud.
Artificial intelligence startups, crypto financial hybrids, borderless digital banks. Everyone promised exponential returns. Everyone claimed to be reshaping the future. Investors who had once learned painful lessons seemed ready to forget them. Inside the same institution, pressure returned. You're too conservative. You're missing growth. You're allocating capital to slow assets. The same arguments from years ago echoed again. But something had changed. The quiet infrastructure portfolio was no longer just stable, it was powerful. The steady cash flow generated over the past decade had built massive liquidity reserves. Debt was minimal, credit ratings were strong, government partnerships were deep. While others were chasing the next breakthrough, this institution had built leverage the quiet way. And leverage, when unhurried, becomes strategic dominance. The leadership made another subtle move. Instead of abandoning their conservative base to chase technology, they began acquiring distressed digital infrastructure during minor corrections. Data centers, payment processing backbones, logistics software integrated into transportation hubs they already owned stakes in. They didn't buy hype, they bought necessity. Every acquisition connected to the original infrastructure web. Energy grids powered the data centers. Transport networks supported e-commerce logistics. Municipal contracts ensured regulatory stability. It wasn't expansion into randomness, it was ecosystem layering. When speculative tech valuations finally corrected sharply, and they did, over-leveraged funds collapsed, overextended startups shut down, markets dipped again. But this time, the institution wasn't just stable, it was positioned. With liquidity reserves intact, they acquired undervalued digital assets at fraction of peak prices. Quietly, no aggressive headlines, no triumphant press releases, just steady capital deployment. That was when the compounding effect turned exponential. The infrastructure backbone generated predictable cash. The newly integrated digital layer generated scalable efficiency. Margins expanded without dramatic risk increases. Millions turned into hundreds of millions, then into billions. Not because of a single lucky bet, but because the original historical decision created the foundation for disciplined optionality. Optionality is the most powerful financial weapon. It allows you to act when others cannot, to buy when others must sell, to expand when others retreat. And optionality only exists if you preserved strength when excitement tempted you. Over time, something fascinating happened in financial circles. Younger analysts studying long-term performance charts noticed a pattern. While competitors experienced dramatic spikes and deep crashes, this institution's growth curve looked almost calm, smooth, upward, resilient. It wasn't the highest performer every single year, but over decades it outperformed nearly everyone, because it never had to recover from catastrophic mistakes. Recovery consumes time, and time is the most expensive currency in finance. The man who had originally leaned forward in that quiet meeting years ago was now older. His hair had grayed. His presence was softer. But his philosophy had permeated the organization. During a private internal gathering, a young executive asked him, "When you first proposed that shift, did you know it would make this much?" He smiled slightly. "No," he replied, "I only knew it would survive." That answer confused some, but survival compounds. Excitement evaporates. The historical decision wasn't about predicting exact profits. It was about aligning with inevitabilities. People will always need energy. Cities will always need infrastructure. Data will always need pathways. Commerce will always need movement. By anchoring capital to inevitabilities first, the institution earned the freedom to explore innovation safely later. That balance, stability first, expansion second, created a machine few recognized until it was too large to ignore. Eventually, global recognition did arrive, not in the form of flashy magazine covers, but in something more powerful. When financial crises hit other regions, governments consulted them. When large funds needed stable anchor investments, they turned to them. When volatility surged, capital flowed toward them. Reputation became currency, and reputation built on endurance is priceless. The millions made from that historical decision were not loud, they were layered. Each year added another layer of compounding return. Each downturn reinforced credibility. Each disciplined refusal to chase hype protected the foundation. By the time the original decision-maker retired fully, the institution had become something far greater than its early members imagined. It was no longer just an investor, it was a stabilizer, a quiet force that reduced volatility within the sectors it touched. And all of it traced back to one moment when excitement was rejected in favor of inevitability. History rarely remembers the loudest rooms. It remembers the rooms where discipline won against distraction. And the true lesson? The greatest financial moves don't look dramatic when they happen. They look boring, ignored, even criticized, until years later when people study the numbers and whisper, "That's when everything changed." Not with a roar, but with a quiet decision that made millions.